welcome to the Lunch and Learn workshop with a glass of wine. We introduced this a few months ago, maybe because we drink too much. I don't know, Adam. I'm not quite sure why we did it, but we ended up doing it. And it's always funny to have a sip of red at midday, which is always good. So I don't know how good it is, but it's all good. For all of you guys that don't know who I am, my name is Paul Jantz. I'll be your host for today, and we're here thanks to Virtual Financial Advice. I'm here with the CEO and founder of Virtual Financial, Adam Besrovic. How are you?
Good, mate. Thanks.
Good to have you here. Now, this series is always, I think when we started this series last year, it was, again, it's good to be back because it was always about bringing some educational to what everyone is doing. It's the old scenario, what you don't know, you don't know. Correct. And these educational workshops were designed to provide all of you guys, our VFA clients, the opportunity to learn more about the investment world. We probably kicked this off a little bit last year as well. Adam, you and I, we did a series, a podcast series or a video podcast series, let's call it. We did that called Talking Numbers Investment Plus, and we did a Talking Numbers Property Plus as well. And we knew it was very, very popular. So for those of you guys that are joining us for the first time that haven't seen a bit of this as well, we have our own Virtual Financial Advice YouTube channel where all of this content will go up to. So if you type into your browser, Virtual Financial Advice into YouTube, up will pop up the content and you can see all the past things we've done, as well as our video podcast series of Talking Numbers Property Plus and Talking Numbers Investment Plus. Today, we're here to talk about a special little relationship that Virtual Financial Advice have with Sequoia Capital. Now, Adam, before we kick off, I might let you say a nice little welcome to all the clients of Virtual Financial Advice and also talk about the exclusive relationship that you have with Sequoia.
Yeah, thanks, mate. Look, it's a great opportunity for our clients to be investing in a great, I suppose, unique investment. What we like to do at Virtual Financial is to try and also give our clients opportunities to not just your standard, superannuation investments or, I suppose, being with an industry fund and just having no advice and no investments. At Virtual Financial, what we like to do is try and help our clients and show our clients, I suppose, where the rich and the people that have got money, like what are they doing? A lot of my clients would be, Adam, what do rich people do? Like, how are they investing? So for me, it's really important that at Virtual Financial Advice, it's all about making financial advice affordable for Australians. So we want our clients also to have access to some of these fantastic opportunities. And we've got Sequoia today. We've had the Property Plus. We've had a number of different opportunities. We talk about the MDA. We're going to be holding our first quarterly MDA update in the next couple of weeks. So that's coming up for our clients as well. So we really want to give our clients education and knowledge to how they can potentially increase their wealth over time.
Very beautiful. And I think there might have been a few of you guys that were at a session where you might have met Blair and Suzanne as well. I'm going to introduce you to our special guests very soon from Sequoia Capital, which is Blair Kirkhope and Suzanne Harding. So again, these are the sorts of things, what we're going to talk to you about today, not me, I'm just hosting. What the Sequoia guys are going to talk to you about today is what only Virtual Financial Advice clients have got access to. And I think that's the great part about what Adam's built. The business that he's built is being able to provide all of you guys as clients these exclusive opportunities to have a look at these sorts of opportunities that you wouldn't usually get in the marketplace. I couldn't just walk off the market and just go and find these guys. This can only happen through what Adam does with Virtual Financial Advice that then introduces these fantastic people at Sequoia Capital. So without any further ado, let's get into this. Suzanne, Blair, welcome. How are you both?
Very well. Thanks very much, Paul and Adam, for the opportunity to be able to present, and very excited.
Yeah, it's great to be on this forum. It really is.
Brilliant. So let's kick off with you guys. Tell us a little bit about your roles. Tell us a little bit about Sequoia Capital.
Okay, so no, thanks very much. So we're part of Sequoia Specialist Investments is the issuer of the investment we're going to discuss today. It's a 100% wholly owned subsidiary of Sequoia Financial Group, which is listed on the ASX. We've been in the market as a non-bank issuer of these types of investments for over 12 years. We've currently have roughly around 400 million cumulative notional. outstanding across a range of different investments. And we look at ourselves a little bit similar to yourself and Adam, that what we're trying to do really is bring to market really sophisticated investment solutions that are not generally available to the public either through the ASX or through traditional wrap platforms, managed account platforms. And the way that we do that is we've established a strong relationship across a panel of investment banks, and that enables us to have direct access to their trading, their structuring, and their research teams to be able to develop investment ideas and opportunities that we can then deliver to clients, special clients in Australia through the relationships that we develop. And we only deal with certain groups and certain advisors, and Adam is one of those, and we're very excited to bring today what we're presenting in commodities.
Brilliant. Suzanne, anything else you'd like to add?
No, but I think it's really important to understand the indexes as opposed to just managers. And that's what Blair will talk to you about today, is that this really is, I strongly agree with everything you said, Paul and Adam, that this is something that rich people, that superannuation funds, that, you know, very select people get to see, and you can't find it. You can't just, you know, look up a share and go, I'll have that, because you're buying a business then, not a commodity. So, and it's also really important to understand structure. And that's something that is complex yet simple. And once it's explained to you, you go, why wasn't I always doing this? You know, how come this is so easy? And
Yes.
this is kind of like the secret that goes on. So yeah, it's cool.
Well said. Now, we are going to talk about the commodity markets today. And I think this is, but before we get into that, Adam, I might just let you, because I know we sometimes forget about this, our general advice disclaimer.
Yes.
Yes, thanks, Paul. So today, obviously, we're discussing this with our clients. We haven't taken into consideration your objectives or needs or goals. Obviously, we do that via a meeting and via a statement of advice. So if after this meeting, presentation, webinar, you'd love to have a look at it, let's have a meeting, let's discuss it, then we'll go through everything with you and present you with a statement of advice.
Good work. Always important to tick the compliance box.
Absolutely.
Yeah.
Thanks, mate.
So the commodities markets is an interesting one as well. And that's why I'm looking forward to this personally as well, because, you know, we always talk about our precious metals that we've got, that obviously there's the soft commodities and the hard commodities and these sorts of things. So Blair, I'm going to go to you straight off, mate. Are you okay to explain to us about what the commodities markets are?
Yeah, sure, of course. So I would say if you look across today, a typical Australian investor's portfolio, they might have exposure maybe to some lithium stocks. They might have exposure to maybe some gold stocks, but it's very difficult, you know, today to actually get direct exposure to the movement in the commodity price itself. And so we think today in an environment where there are a lot of issues around climate change policy that can affect a number of resource companies, you know, so a bank might decide to stop lending to a coal company, or they might stop providing finance because of certain political pressure or certain climate change policies. But in this sort of high inflationary environment, which based on the models that we follow is likely to continue for many years to come, the commodity price itself is an input into inflation. And we think it makes a lot of sense to sort of remove some of that equity risk. You might have, you know, most clients will have a, you know, a decent equity portfolio, but to bring just a pure commodity price exposure to the portfolio. And in that way, it helps to hedge against inflation. It enables the investors to just take advantage of, you know, shortages that could occur across different commodity markets, and not necessarily relying on, you know, a company itself to run the company well and generate profits and deal with supply chain disruptions, etc. We just play the commodity price. It removes all of that risk, and just, yeah, it's a direct inflation trade from that perspective.
Yeah, well said. And I think, you know, I suppose it's an interesting one. It's always in the talk at the moment because of probably the prices of things going up, I suppose. And you look at Australia as a perfect example of where most of our gas is being sold overseas, which forces prices up for consumers here. Us,
Yeah.
and that just in our homes. You know, if you're working from home like I am, and in the middle of winter, in Melbourne, you got to have your heater on, and
Yeah, no,
your
exactly.
prices are going up.
Yeah.
So, Blair, why do you why are you bullish about the commodities markets right now?
Yeah, so that's, I mean, very good question. So I would say it really came about, it really started, I think, during COVID. So we saw, for the very first time, I think, since I've been alive, we've really seen some supply shortages across many of the different sort of commodity spectrum unfold. And that was really due to the lockdowns, I'd say, the supply chain disruptions, as I mentioned. And I guess going into sort of early 2022, the expectation was that everything would sort of come back to normal. The world would just return to where it was pre-COVID. And that was pretty much why we saw the RBA governor come out and sort of expect that, we're not going to increase interest rates. Inflation will revert back to normal. Everything's going to be fine. They obviously completely missed the boat in terms of really see what was coming down the line. And what really took everyone, I guess, by surprise was what happened in Ukraine. So historically, when you look back to the Vietnam War or even World War II, the most important driver of inflation historically has actually always been international war. Yeah. And of course, that it's a difficult topic to discuss, but that is continuing. So that's on one side. We can see the global economy itself really started to sort of split. So you're not seeing the free flow of commodities around the world like we once used to, and that's feeding into the equation as well. So we look at, I'd say the 3 or 4 major drivers. It's the climate change policies. There's divestment away from fossil fuels, creating more shortages. I would say that the international war, risk of further escalation and the impact on supply chains from that's a major issue. And the deglobalization of the world. So the sort of onshoring of activities. And then, of course, you've got extreme weather. You've got OPEC cuts. There's that's feeding into the geopolitical situation as well, what's happening with Saudi Arabia and the OPEC cuts as well. So it's a complex picture overall. There are a number of factors that are driving it from a fundamental point of view. And a lot of the investment banks are coming out with some very strong, I would say, bullish forecasts across the energy sector, the industrial metals and precious metals as well. And that's in line with some of the forecasts that we're seeing from institutions that are not part of the investment banks. We follow a very important cyclical analysis, Armstrong Economics, and they've really been highlighting the fact that we're expecting quite a large turning point to unfold right now from a cyclical standpoint. We've seen commodity prices really take off into early 22 when Ukraine was invaded. It sort of pulled back. You see across most of the commodities over the last 12 months, and we think that's really presenting an excellent entry point for a number of investors to really take advantage of that pullback in price, on the understanding that the bull market that is in play is likely to continue, and that's really the reason why we think now is a really interesting point in time for investors to consider adding a direct commodities exposure to their portfolio.
Okay, yeah, well summed up. Suzanne, anything else you'd like to add to that?
I think it's interesting talking about what Blair's saying, and some people might think that they've got commodities covered by shares like BHP or
say that. Yep.
Something like that. And what you're actually buying is the company and the manager. You're not buying the commodity index. Sure, they work in, gas and oil in those fields, but you're not buying the index. So you are relying on who's the CEO, have they blown up a sacred site recently? Is somebody being sued? Yep. You're relying on those kind of things. Not saying that there's anything wrong with holding those shares, but it's not a true exposure to a commodity market.
Okay, interesting, because you're right. I was going to go into BHP or Rio as commodity exposure, but I suppose is there an existing trading fund on the ASX at the moment that would enable me to have broader asset class exposure?
So that's so at the moment, as far as we're aware, no, that's not the case. So that's been the issue within Australia, to have that broad commodity, diversified commodity exposure. Yep. In a single investment in the way that we're offering it is very difficult to access. So that's part of the reason why we've offered what we do offer. And so for us, one of the key things really is how do we provide exposure to commodities in a way which enables clients to get exposure, but without sacrificing too much portfolio income or too much capital growth potential from the rest of the portfolio. We understand, Adam's going to have the core portfolio in place. We don't really want to come and really ask to disturb that. That needs to remain more or less in place. But how can you do it in a really low cost way to get exposure, to get a decent exposure to the commodities market in a diversified manner? And that's why we're doing it in the way that we have, and happy to talk through that in some detail.
Let's talk about that then.
Yeah.
let's talk about the investment that you have available. I know there's a number of things in here. So all of you that are online as well, we spoke about, there's the terms of the investment, the limited recourse loan, the risk, the flexibility to being, call it locked in or not locked in. And maybe if you can go into also the tax deductible aspects as well. Are you okay to go through that? I know there's a fair bit there.
So there's a bit to take. So I might really just simplify it down to just a one-liner just to explain it. So for 8.85%, you're able to obtain 100% exposure to a diversified commodities portfolio for 18 months. So in an example, if you wanted a client wanted $100,000 of exposure to 13 commodities, it would cost them $8,850 of interest. But the out of cost in terms of interest, and then in terms of any fee for advice, then Adam, that's something that you would have to charge separately, of course. So and then typically it would be $9,950 would be the total upfront costs covering the full term. So for less than 10 grand, clients are getting $100,000 of exposure to the commodities market for that entire 18-month term. And so in terms of tax deductibility, the $8,850 is tax deductible. That's amortized over 18 months. So for this particular investment, it would be starting on the 15th of September. So roughly 8.5 months worth of interest would be effectively claimed during the year ending 30 June 2024. And then the remaining interest would be claimed in the year ending 30 June 2025. Okay. So there is a tax deferral element that's involved here because there's no income that is brought to account during the first tax year ending 30 June 2024, notwithstanding the fact that there is a tax deduction for part of the interest during that year. And so from that perspective, it's beneficial as well.
Okay, and that'll be split over the 2 financial years.
Exactly.
Yep. Now you mentioned, I think you said 13, I caught quickly. So there's 13 commodities included in the index?
Yes.
Why 13?
So that's the standard benchmark sort of inclusion for commodities across 3 sectors. Okay. So it covers energy, the energy sector. So that would include, for example, natural gas, WTI crude, Brent crude, gasoline, diesel, low sulfur gas oil. So they are the benchmark commodities for the energy sector. It also includes industrial metals. So there we're including copper, aluminium, lead, nickel. So again, they're the benchmark industrial base metals that are included within that particular sector. And then precious metals, we're looking at gold and silver. Okay. So we take all of that combined as a diversified exposure across a broad spectrum of commodities, but through a single investment for a low cost of $9,950 covering the 18-month term. And that's how we like to do it. So the worst case really, when we look at, we can talk about, okay, how do clients generate a return from that? So what happens is, in terms of the investment return, what we do is we look at that example of $100,000 of investment exposure, and then we look at the performance of the underlying index and we apply that to the $100,000. And then we pay that return back in the form of income. We call it a performance coupon. That's how it's termed, but it's effectively income, which is paid at the end of the 18-month term. And that's calculated again by reference to the performance of the index applied to the $100,000. So let's take an example. We can talk through a few examples. Let's do that. Let's say the index was up, say, 10% at maturity. That's a pretty small amount. in July, it was up 4.5%. But let's say after 18 months, it was up just 10%. We would pay a coupon of $10,000.
Yep.
And so in that case, clients would effectively be breaking even. It cost them $9,950. They're effectively getting their money back at the end of the 18-month term. But our sort of objective and investment objective for this particular investment is for investors to double their money effectively. So where our expectation is that the index would be generating approximately 20 to 30% return over the 18-month period. That's sort of in line with the forecast that we have. And if that does, we're not saying that will occur. There's certainly no guarantee that it would occur, but if it did occur, then at maturity, the performance coupon in the case of 20% would be $20,000. Yep. So 20% times 100,000 is $20,000. Yep. If it's up 30%, it's 30% times $100,000. So it's a $30,000 performance coupon.
Okay.
So so that's sort of our objective, and that's how the return would be paid back at maturity. I don't know if there's anything you would like to add.
Try and keep it quiet.
Yeah.
Especially when there's wine involved. You know, like, let me at it. No, look, it is a very interesting concept, and people sort of look to me, because I'm quite often at the coalface of talking to advisors and saying, you know, I don't get this. How come? And it's because it is a loan with limited recourse. So it means that nothing else is touched. So the investment bank is lending the money to invest back in that commodity index. So they're kind of backing themselves a little way. They also believe that it's going to go up. That's why they're lending the money to go back into their product. As an example, this is Series 18 on the commodities market. And Adam, you and I were talking when Series 17 launched, and we traded on the 2nd of July. I'm personally an investor. And so far, that index is up 4.5% in the first month we traded. So it doesn't have to do too much to get into positive territory. So at 10%, it would be up. The other thing to be aware of is this is liquid. Even though the term of the investment is 18 months, at any point during the 18 months, we can close down the investment. So Adam might come to us and say, thanks, Blair, you've sent us our monthly email and the investment is up 25% and we're month 15.
Yep.
I don't want to stay till month 18 because what's going to happen in the last 3 months, and I'm really happy with 25% over 15 months. I want to unwind all of my clients. That is possible.
Yeah, so daily liquidity is a really important point we wanted to emphasize. So there's no lock-in period. Investors can exit at any point in time. If they change their mind after a month for whatever reason, we will provide an unwind price at that point as well. So look, it's fully available at any point in time to take the value back at that particular point in time. One point to mention, I would say, in relation to the $100,000 of investment exposure. So the way that mechanically works is that Sequoia will lend $100,000 to the client. The client will invest $100,000 into the product that we issue.
Yep.
That loan is limited recourse. So what that really means is that should the index be negative at maturity, so in the worst case scenario, the index might fall 50% in the absolute theoretical worst case scenario. So in that case, investors simply walk away from the loan. There's no need to repay the loan. So there's no risk at all in relation to the loan. So they get all the upside in relation to the $100,000 of investment exposure, but no downside risk in relation to the $100,000. And the reason that's possible is because there is an element of inbuilt protection when we actually go and hedge this investment with the investment bank. And that's included within the interest rate. So there's no sort of magic involved here. It's part of the product engineering and the product structuring that we're able to offer something that's limited in recourse in that fashion.
Yep.
And so just wanted to really emphasize that point.
So therefore the risk that's involved is the $9,950 that you spoke about.
Exactly. So
it's tax deductible.
Yeah.
So your position isn't the full $9,950, depending on your personal situation, whether it's inside or outside super, any of those things. it is less than that. So your worst case scenario is the 9,950 minus the tax advantage you get from that.
Yes, which is your net effect.
Exactly.
Yeah.
Okay.
Yeah. The other thing that's really great to note, again, trying something else, is that this can rebalance your portfolio without using a lot of your cash. And, you know, again, I can look at my personal situation that I might have a property inside my super fund. I might have some equities, but I have no commodity exposure, but I don't have much cash in there. So for, you know, 10 grand, I can get 100 grand's worth of exposure. So when I look at what my portfolio is valued at, it is whatever it was plus $100,000. So my portfolio value has gone up as well. And there's no margin call. So I'm not like the old days where you would, you know, get a loan and buy equities and they might come back later and ask you for more money. None of that happens.
Okay.
So it's a very clever way to get exposure on a big number for a little number's worth of cash.
Yep.
And as an issuer, as you might be aware, that we're required to issue what's called a target market determination and identify the type of target market. And so what we typically see, it's really only just a small allocation of a portfolio for this type of investment, because we're looking for, you know, you're getting a large exposure for a minimal upfront cost. So you're only looking to allocate only a very small part of the overall portfolio to this investment in order to get the exposure. And that enables the clients to retain the very large proportion of their income and not sacrifice too much income or capital growth potential from the rest of the portfolio.
So fair to say, there's two things, because I haven't heard about a performance coupon before, so you might want to just expand on that a little bit more. But this is a income based, because it's coming back as income, isn't it?
Yeah, that's right.
Back as income.
Yes.
And so you're investing into an income product, which is
I think we need to be careful about how we describe that. So from a tax point of view, it is classified as assessable income, the performance coupon. But from an investment perspective, this is a geared investment. So it really is about looking to get sort of capital growth on the underlying commodities index over that 18-month period. So clients should not be expecting to really rely on, you know, regular income for living from this particular investment. That's from your dividend portfolio or from other income generating assets within the portfolio. This is really about a geared exposure to the commodities asset class in a very low cost manner at a time which we think is optimal from an entry point of view, and really looking to get a sort of a high return on the cash invested over that time.
Yeah, good. And I like, Suzanne, your thought process before that you mentioned with regards to, I know, having sort of run these lunch and learns with a wine over the last couple of years, a lot of the times we talk about diversification. And you're right, there are a lot of self-managed super funds that are highly geared probably in the property side. So therefore, this is a good way to diversify that and get into these commodities markets.
Yeah. And I think it's really important that this is the type of thing that Adam and his team do. Like, this is something that you need a clever financial advisor to look at your portfolio and go, you've got, you know, some equities, you've got some properties, there might be some holes here. We can fill it with a big number for a small outlay.
Yep.
And again, yes, I know we've said this is general advice, but this is something that if you think this is of interest, you should really sit down with your planner and go, okay, how does this work? How does this work? Because this is actually quite clever stuff.
Yeah, I agree. Now, we spoke about self-managed super funds. Can I invest as a self-managed super fund in this as well?
Absolutely, yes. So I would say probably 70% of our investors are SMSF investors. So specifically designed to ensure that it meets all the requirements under the CIS legislation. So yeah, 100%, that's completely fine.
Blair, I was just going to ask, one of the accountants has just asked a question there in regards to, is there a product ruling or it's just a tax?
Good question. So on this particular one, there's no product ruling. And the reason for that is because really under the tax legislation, the deductibility of the prepaid interest on this particular product is very clear. And the reason for that is because the objective really here is for the performance coupon at maturity is actually assessable income. So investors are incurring the prepaid interest for the purpose of generating the performance coupon at maturity, which we expect to be greater than the prepaid interest expense. So, and the capital protected borrowing, there is a capital protected borrowing legislation within Australia. The interest rate is only 5.9%. And so that's a long way below the capital protected borrowing limit that can apply sometimes to these types of investments. So there's just, in this particular case, there's really no sort of risk or issue associated with claiming the tax on this particular investment. So that's why there's no product ruling.
I will say Blair is a tax guy from way back. So.
Yeah.
Not currently, but that's part of my old career, yes. But happy to talk to in more detail, and feel free to pass it on to okay.
Yeah, good.
Okay.
And look, that's just there's a number of accountants that were keen to sort of hear things as well as we spoke about before.
Fantastic.
So they're going to look at things from a different angle. But look, it's a good opportunity. Adam, I don't know if you've got any other questions that you want to go through, mate, but it's a good opportunity for anybody else online. If you want to throw any questions in there, we've probably got about 10 minutes left. So if you want to throw any questions in there, and obviously if it goes into a more detailed discussion, we can have that detailed, well, not me, detailed discussion with you, certainly with Adam as well.
One of the questions is like the questions from an accountant. So what are you actually investing in? What are you actually buying?
Yeah, so so good question. So we issue what's called a deferred purchase agreement. So that is the sort of the name of the legal instrument that we issue. So it's not a fund. It's like think of it like a structured note. It tracks the performance of the underlying index and includes all the terms and conditions of the investment up front. So we issue a PDS. So there's a PDS, there's a flyer, there's a TMD that includes all the terms and conditions. But the legal instrument of the underlying investment is the deferred purchase agreement. And that's the most common legal wrapper that's used for structured products in Australia that are unlisted.
Yeah,
so it's been around for about 15, almost 20 years now. So very common. It's just a very flexible instrument that can be used for structured products. So happy to talk that through.
No, and if the accountant has any more questions, can he just call you direct and have
absolutely.
Yeah, that might be the easiest way with questions that are coming from that accountant. Yeah, cool.
Sure.
Okay. So another question from someone else. Traditionally, high returns, high risk.
Yes.
What is Blair not telling us? So it's coming from one of our.
No. So it is, of course, this is a high risk investment with the potential to generate a high return. Absolutely. So of course, investors can lose 100% of their upfront costs. So that's the worst case scenario, is that investors can lose the 9,950. So in that case, you would lose 100% of your upfront cost.
Yep.
Of course, you do get a tax deduction for that. And that's why from a portfolio allocation perspective, you would only consider a very small part of the portfolio to allocate to this type of investment, of course. So no, there's no, like I said, there's no magic here. Yes, you can lose the 9,950 if the index falls for whatever reason. Yeah. Our view, of course, is that we're within a very bullish trend. It's within a broader inflationary environment. We think everything that we're looking at is suggesting that should continue. Commodity prices have pulled back significantly. It's a great entry point. So the probabilities we think are in the favor of the investor. However, we can't discount, of course, the possibility that this doesn't come to fruition, the index falls, and of course, if that does occur, then clients would lose 100% of their upfront cash costs, but never more than that. So they're never at risk in relation to the $100,000.
Yeah, and we'll explain that to the clients as we see them and have that one-on-one meetings with them.
Yeah,
it's just a small portion of their portfolio, but it's just to give them a bit more exposure. So where we kind of at Virtual Financial see using this investment really is with a lot of our self-managed fund clients have property in their fund, don't have too much else extra. So it just gives us an opportunity to maybe broaden that investment exposure. The ATL always harping on about diversification, other assets. So it kind of helps in that regard if we can kind of get some exposure to commodities. So that's how we're kind of be talking to our clients about this.
Yeah.
An opportunity. So no, but they got to understand that yes, what they're risking is the interest up front. And that exactly. if the thing goes backwards, that's all they're going to lose. So as I say to all clients, if you can't sleep at night knowing you're going to lose that, don't invest. It's quite simple.
Yeah, that's a good point. And to be fair, when I checked you guys out online, this is not your first rodeo. So how many other have you done? Because when I looked at it, there was about 16 or 17, wasn't there?
Yeah, so we were very strong during, I'd say, mid-2021. So the second half of 2021, we issued about 7 or 8, not even 9 commodity investments. That was when we believed that the commodity market first entered a bull market after the crash during COVID. So a lot of commodities crashed during the COVID, and after about 6 months going into, or more than that, probably about 18 months after that sort of early 2020 crash, we felt, okay, we're starting to make new highs across a number of different commodities. There was some strong sort of analysis coming out from the investment banks supporting a continued bullish trend. So we launched a large number at that point in time. And more recently, we've started to issue again. So in total, this will be our 18th in total.
Okay.
Yep, on commodities. Across all asset classes, we've issued over 125 over 12 years.
Right. There you go. So that's a good number, because I think that's important.
Yeah.
So everyone's sort of hearing that as, again, I think everyone will do their research anyway. Like I've
done,
of
course.
The sort of things that I've found that ticked a few boxes for me personally.
Yeah. No, we are, I'd say, one of the leading non-bank issuers of structured investments for the retail market in Australia. That's definitely the case.
Brilliant. Any other questions? Thank you, Gary. Thank you, DMAC. Always good to have you guys online and asking good questions.
Yeah, exactly.
We know we're going to get good ones from those guys. So yeah, look, if you've got any other questions, throw them in there. Before we look to wrap up, we're at 12:38. We said we're going to go till about 12:45, so we've got plenty of time. Suzanne, I'll go to you first. Anything you'd like to wrap up with?
No, but I think it's important to note that this is something that we have taken to Virtual Financial. There was an application fee on this product that we normally charge that we've dialed off, so that the clients can do this sort of at sub $10,000 per 100,000. So we're aware of that. And look, I strongly recommend, if you've got any questions, feel free to shoot them through. There's nothing being hidden here. It's a very transparent sort of operation. We're all investors. We all understand. We're very pleased so far with Series 17, which is our latest commodities one. So, and I think Blair's got all the presentation material that can talk about the graphs and why he believes this is a low entry point still, and that this market has some more to run. And I think one of the important things to note is that there's an election in the US, because this is obviously a US commodities play. You know, it's done through those big commodity indexes, and that will have an effect. So we're running up to that lead. You know, whatever your political stance is, it certainly has an effect on the markets.
Yep. Well said. Blair, any final comments, mate?
No, I just say thank you for the opportunity to present, and we think it's a great opportunity, and fully available to us to answer any questions, or feel free to reach out to Adam and or come back to ourselves, and yeah, totally available to answer any questions.
Agree totally. I think you guys are quite happy. I think your comment was, Suzanne, with the current.
Oh, yeah, I am.
Are you allowed to say what it is, or did you already say it?
So we traded Series 17 on the 2nd of July, and Blair did, the first month's report, and it's up 4.5%. Okay. So if we're talking about 10% gets you at even, and obviously anything above that is great. That's pretty good for 1 month.
Yeah, I would just add, I will add something here. The forecast on the energy sector from Goldman Sachs for the next 12 months from 1 July is a 58% increase in the energy sector. It's about 28% for industrial metals. So they're very bullish on those, especially those two sectors. Yeah. And you can see, if you look at the price action on oil and natural gas, you can see it's starting to turn, especially across those two. Also gasoline and low sulfur gas oil. So happy to share a lot of that information if it's helpful.
Good job.
Great.
Adam, any parting comments, mate, as we look to wrap up? I know, obviously, if anyone's got any questions, certainly from a VFA point of view, chat to Adam, chat to Rod, chat to LJ. They're probably your first point of contacts as such as the advisors of Virtual Financial Advice. But Adam, anything you'd like to say, mate, before we wrap up?
Yeah, look, I think for all my clients, this is a great opportunity to diversify your portfolio. Highly recommend it. Highly recommend you have a look at it. And there's going to be more and more investments coming along. So please, if you haven't already liked our Facebook page and our LinkedIn page, that's where all of our webinars are coming up. So we're going to be having, our MDA. There's other investment opportunities going forward. We're here to really help our clients grow their wealth. It's not just about the wealthy people that can afford to pay, Macquarie Bank $1 million a year. We're here to help, our clients to really generate a lot of wealth, and that's what we're all about. I'd like to really thank Blair and Susanna for their time. They have a great portfolio, and obviously the company's ASX listed, so we know that it's a great company to do business with. They've done over 125 investments, so have been fantastic. So we're very happy to really give these opportunities for our clients, and not many, no one at Q Super, or no one at Sun Super, or no one at BuzzQ, they don't have access to these sort of investments. So you're very lucky to, in a lot of ways, that you're with Virtual Financial, because not many firms, unless you're with a firm and paying $20,000-$30,000 a year in fees, will you get opportunities like this.
Yeah, well said, well said. And I apologize for my phone ringing at that last second. So, I agree. Thank you, Blair. Thank you, Suzanne. I think certainly, I always look to take one thing away from the day and look to learn something. And that's always been a big part of my life. So certainly I've learned a lot, and it makes me think about the little things that I can tick off on my list, and especially what Adam's mentioned just then and what you guys have gone through. So thank you for your time. I think everyone online will certainly, again, be very grateful for the conversation and what we've been able to generate and learn today. So thanks for both of you for joining us. Adam mentioned it before, to all you guys online that haven't already liked our Facebook pages or our LinkedIn pages, that's where all of our information goes. So please jump on there. If you want to check out our podcast series as well, make sure you check out Talking Numbers Investment Plus and Talking Numbers Property Plus. Signing off until we probably see you guys next time. So enjoy the rest of your day. Thanks again, Suzanne, Blair, and thanks, Adam.
Thanks very much.
Thanks,
Adam.
Thanks, guys.
Cheers, guys.
Thanks, everyone.
Thanks. Bye.
Bye.